What if I told you there's a clean energy company that just posted 41% revenue growth and has hundreds of megawatts of data center deals in the pipeline? FuelCell Energy just dropped their Q4 earnings, and the numbers tell a story that most investors are completely missing. While everyone's chasing the next AI stock, there's a massive bottleneck forming that could derail the entire artificial intelligence revolution: power. And FuelCell might have cracked the code. Let's count down the top 10 takeaways from this earnings call that could change everything. Starting at number 10, let's talk about the elephant in the room: power constraints. The traditional power infrastructure is broken for data centers. We're looking at 5 to 7 year wait times just for utility interconnections, and new substations take just as long. Traditional gas turbines? 3 to 5 years before they deliver power. FuelCell's carbonate fuel cells sidestep all of this. Their modular 1.25 megawatt power blocks can be deployed without new high-voltage interconnections. They come online faster, and they deliver energy costs comparable to turbines with way less permitting risk. This isn't theoretical, it's happening now. Number 9 is about a feature that most people overlook: cooling integration. Data centers have a dirty secret. About 1/3 of their power consumption goes to cooling. In a 50-megawatt facility, that's massive overhead. FuelCell's platform operates at high temperatures, which means they can integrate steam absorption chilling directly into their systems. The result? They can reduce cooling load by approximately 5 megawatts per 50-megawatt data center. That's not just efficiency, that's a competitive advantage that directly hits the bottom line for data center operators. Coming in at number 8 is their carbon capture edge. FuelCell is working with ExxonMobil on a demonstration project in Rotterdam that's scheduled to go live in the second half of 2026. Here's what makes it special: their technology can capture over 90% of carbon dioxide while simultaneously producing power and hydrogen. No other technology can do all three at once. They're already building the modules, and once this demo proves successful, they're positioned to pursue commercial carbon capture opportunities at scale. Number 7 is all about policy tailwinds. The investment tax credit got extended through 2032 as part of legislation passed in July. That's a 30% credit off capital costs, and it fundamentally changes project economics for FuelCell and their customers. While other generation technologies don't qualify, FuelCell's platform is positioned to take full advantage of this incentive, making their solution even more cost-competitive against alternatives like engines and traditional turbines. At number 6, we see incredible momentum in Korea. FuelCell has established itself as a leading partner in South Korea, which is the largest fuel cell energy market in the world. They currently have over 100 megawatts in backlog with another 100 megawatts under Memorandum of Understanding. That's 200 megawatts of pipeline in a single market, including repowering opportunities and new projects like the potential Enuverse data center collaboration, which could become Korea's largest. Number 5 shows real financial improvement. Their adjusted EBITDA improved by 26% year-over-year, reducing losses by over $25 million. The restructuring efforts they implemented throughout fiscal 2025 are delivering tangible results. They cut research spending on non-core technologies, reduced operating expenses, and sharpened their focus exclusively on their proven carbonate fuel cell platform. The discipline is paying off. The number 4 takeaway is revenue growth. FuelCell posted revenues of $158 million for the full year, representing a 41% increase from the prior year. This wasn't just accounting magic. They delivered 22 actual fuel cell modules to Gyeonggi Green Energy in Korea. Product revenues, service agreement revenues, and generation revenues all moved in the right direction. This is real hardware being deployed and generating real cash. Coming in at number 3 is their rock-solid balance sheet. They ended the quarter with $342 million in cash and just secured an additional $25 million in EXIM financing. CFO Mike Bishop made it clear they're comfortable with their current liquidity position and don't anticipate needing to tap capital markets in the near term. They're planning $20 to $30 million in capital expenditures for fiscal 2026 to begin capacity expansion, but they're fully funded for their current growth trajectory. The number 2 takeaway is their aggressive data center strategy. FuelCell has hundreds of megawatts of pricing proposals out across the entire digital infrastructure ecosystem: hyperscalers, utilities, power land developers, infrastructure players, and sponsors. Their collaboration with Diversified Energy creates a powered land solution combining gas infrastructure with power generation. These aren't tire kickers. These are active discussions with real potential to convert into executed contracts throughout 2026. And the number one most important takeaway: manufacturing scale and the path to profitability. FuelCell is currently running at 41 megawatts annual production rate. Once they hit 100 megawatts annually at their Torrington facility, they expect to achieve positive adjusted EBITDA. And here's the kicker: they can scale that same facility to 350 megawatts of annual capacity with modest capital investment in less than 18 months. The infrastructure is there, the technology is proven, and the demand is building. This is the inflection point investors need to watch. Drop your thoughts on FuelCell in the comments below, and don't forget to subscribe for more earnings analysis from Earnings Central.